As Sino-US trade tensions flare up once again, global financial markets are shrouded in uncertainty. And the cryptocurrency market is facing a stern test. After several rounds of negotiations, China's tariff on the United States has now reached 84%, while the tariff imposed by the United States on China has reached an astonishing 145%. The tit-for-tat between the world's two largest economies continues to escalate, with no signs of easing. This retaliatory trade conflict has investors worried about when the global economy might recover. Currently, Bitcoin's price has pulled back to around $80,000, but the future trajectory remains uncertain. Beyond the trade war impact, the crypto market is also under multiple pressures. First, tighter regulations. The EU recently passed the Markets in Crypto Assets Micro-regulation, and the U.S. SEC continues to intensify scrutiny on exchanges. Second, liquidity crunch. The Federal Reserve maintains its high interest rate policy, and a strong dollar is dampening the allocation to risk assets. Third, geopolitical risks. Turmoil in the Middle East has pushed up energy prices and heightened inflation expectations. In addition, trade war-induced supply chain disruptions may affect the supply of mining machine chips, indirectly impacting Bitcoin network hash rate. As the world's largest mining rig producer, China could trigger a new round of industry reshuffling if exports are restricted. On-chain data shows that centralized exchanges saw a net outflow of 120,000 BTC in the past week, marking a new yearly high, indicating that large holders are moving assets to cold wallets for safety. In the derivatives market, Bitcoin futures open interest has dropped by 15%, and funding rates have returned to neutral, suggesting that leveraged traders are exiting the market. A Wall Street analyst pointed out that when the correlation between traditional markets and the crypto market increases, Bitcoin's digital gold narrative comes under pressure. Currently, the 30-day price correlation between gold and Bitcoin stands at 0.65, indicating that investors are increasingly treating it as a risk asset rather than a safe haven. So, how should regular investors respond? First, reduce leverage. High leverage positions are easily liquidated during periods of high volatility. Second, focus on counter-cyclical assets. Tokens related to decentralized storage or AI computation may exhibit defensive properties. Third, adopt a DCA strategy. Use laddered buying to average down costs, with a focus on mainstream coins like Bitcoin and Ethereum. Fourth, monitor policy shifts. The period around the August 1st implementation of the new U.S. tariff list could be a critical turning point. Although the market is highly volatile in the short term, this correction may present an entry opportunity for long-term investors. The cyclical nature of the crypto market has never changed. Every deep pullback lays the foundation for the next all-time high. As Bitcoin's halving effect gradually kicks in, the market may see a recovery window in Q3. At present, the fate of the crypto market is deeply intertwined with global political and economic dynamics. Every move in the Sino-US trade war could either be the last straw that breaks the market or the pivot point for a rebound. Investors must stay clear-headed in the storm, avoiding short-term risks while preparing for the next cycle. That's all for today's episode. Thank you for watching, and see you next time.